Lesson 1. What is the Forex? Before we get started, I would like to point out a couple items. Number 1, each slide is numbered. So if you look at the bottom of your screen in the center, you will see the number 2. That is because we are on slide number 2. And as you look in your workbook, at the bottom of each slide, there is a number in the center. As we go through this presentation, you can keep up with this presentation going slide by slide. The second thing is that all through all 16 lessons, I have taken the time to put this sign up in the top left-hand corner, important information. Whenever you see that sign on any of the 16 lessons, that sign is an indication that there is some critical and important information on that slide, and that you as a trader should take the time to really understand the information on that slide, even memorize it, because they are trading tips and techniques that can really improve your trading. There are 16 lessons in this whole presentation on trading the Forex. However, there are virtually 16 lessons on trading and on technical analysis. Now, technical analysis is the study of charts and their movement. So basically, if you get an education on technical analysis, you're basically educating yourself on any type of chart movement and how to trade it. The greatest thing about learning technical analysis and chart reading is that it's applicable in all markets. Several years ago, I heard this statement, and it's probably one of the most profound statements I have ever heard. Successful traders will do what unsuccessful traders can't and won't do. What's the difference between you and a successful trader? Obviously, education, experience, understanding of the market, understanding of their own emotions. Successful traders have a clear trading methodology and understanding of the market, and that makes them different, and that allows them to do successful things in the market that unsuccessful traders can't and won't do. These lessons can participate greatly in helping you become a successful trader. Now, there is a 21-day 3% rule that I learned about several years ago. It basically states that the human mind forgets 80% of the knowledge it acquires within 3 days. That means as you watch this lesson and all the other lessons about trading, if you don't use it, you will lose it. And you will lose 80% of the information within 3 days. Over the next 18 days, it will continue the loss of information until it settles at retaining only 3% of the original acquired information. That means that after 21 days, you will only have retained 3% of the information that you will be shown during these presentations. So please go back and review these tapes and CDs and understand what there is to know on trading so that you can become successful. Invest in yourself. Now, by the end of this lesson, you will understand more about the Forex. You will understand how to trade the Forex. You will understand that the Forex is a market for speculator trading. You will also understand that the Forex moves just like any other market, up, down, or sideways, and you will learn the different types of orders used in trading on the Forex. You will also learn how to place a trade on the Forex. Market Traders Institute Incorporated and ForexTips.com Incorporated teaches people how to trade. Let's get started. What's the difference between the Forex and the stock market? Well, we all know the stock market is virtually purchasing a stock or part ownership into a company. The Forex is virtually buying and selling money. The currency of a country is virtually a stock certificate of that country. The FOREX stands for foreign exchange. Traders call it the spot market or the cash market. It is comprised of approximately 4,500 world banks trading their country's currency for another country's currency. It is traded in cyberspace. It is not the futures market. It is not traded in a pit. It is the largest market in the world. Reports are that $1.5 trillion a day is traded on the FOREX. It literally dwarfs the U.S. Treasury bond market or the U.S. stock market. U.S. bond market trades about $300 billion a day. U.S. stock market about $100 billion a day. The volume on the FOREX is more than all other world markets combined. It's traded 24 hours a day. As a matter of fact, there are 3 trading sessions every 24 hours. The FOREX opens up approximately 7 o'clock p.m. Eastern Standard Time on Sunday evening and closes Friday at 4 p.m. Eastern Standard Time, and literally goes uninterrupted 24 hours a day from that Sunday's opening till that Friday's close. In a 24-hour period, there are 3 trading sessions. The first session that begins around 7 p.m. Eastern Standard Time and goes until 6 a.m. Eastern Standard Time is Asia. These are all the markets over in Japan, Hong Kong, China, Taiwan, Taipei, Korea, all the way down into New Zealand and Australia. Those markets are considered the Asian market. They overlap the European market. Europe opens up at 2 a.m. You can see that at 2 o'clock in the morning, between 2 and 6 a.m., Asia and Europe are open. And Europe goes until 11 a.m. Eastern Standard Time. Then the U.S. market opens up at 8 o'clock in the morning until 5 p.m. Eastern Standard Time. These are all the markets starting in Canada, going all the way down the United States, Central America, all the way down into South America. You can see that Asia and Europe overlap for approximately 4 hours, and you can see that the United States and Europe overlap for approximately 3 hours. And then the cycle begins all over again at 7 o'clock and repeats itself 24 hours a day. Now, why is the FOREX new? Well, the FOREX is not new. The FOREX has been around for quite some time. However, it is new to the small investor. Back in approximately 1995, 96, the FOREX opened to the small investor, allowing them to get involved in trading on the FOREX. Margin requirements changed. Prior to 1995, if you wanted to trade on the FOREX, you had to have a financial portfolio of approximately $1 million or more to trade on the FOREX. Now the small investor can get involved. The small investor is an individual described as one who has approximately $2,500 of speculator capital to invest in the market. Now the FOREX has $1.5 trillion in daily volume. What does that mean? Well, that means there are unlimited buyers and unlimited sellers on the FOREX. That also means that it is very liquid, easy to get in and easy to get out. As a matter of fact, fills or your orders are filled within 3 to 7 seconds, 24 hours a day. It also means that you're not subject to some of like these stock buys, to where you purchase a stock, you find out the stock is not a very good stock, you got in on a hot tip and you're getting ready to get burned and you want to get out of it, but the stock is now not very liquid, and you tell the broker to sell it. If this stock gets down to $17, sell it. And the broker calls you back and tells you that he couldn't find a buyer until it hit about $8. And some of you have experienced that. The FOREX is very liquid. You don't have that type of problem on the FOREX. There's 6 major investment choices that we urge all our traders to focus in on, and those are the main world currencies, the 6 main world currencies. The stock market has over 40,000 different stocks to choose from. If you are a focused individual, or you're an individual that believes in focus and in niche, then how do you begin in the stock market with over 40,000 different stocks to choose from? On the Forex, there are 6 main currencies that we focus in on: the US dollar, the British pound, the Japanese yen, the Swiss franc, the euro, Canadian dollar, perhaps the Australian dollar. Those are 6 very liquid currencies that are very easy to trade. We have 4 trading strategies that we focus in on. The market only goes up, down, and sideways. As the market is going up, we teach a strategy on what to do, how to enter the market, and how to financially protect yourself. As the market comes down, we teach you how to make money as it comes down. We show you how to get in the market, how to enter, how to make a profit, and how to protect yourself. When it's going sideways, we show you how to get in, how to make a profit, and how to protect yourself. And the 4th strategy is we show you how to identify the reversal. What goes up must come down. What goes down, predominantly in the market, does come back up. We teach you how to spot that reversal so that you can take advantage of these big moves and get in at the beginning of a move. The neatest part about the Forex is it's traded 24 hours a day. You're able to trade it at your convenience, call your own shots. If you're a doctor, lawyer, engineer, architect, entrepreneur, employee, doesn't matter what walk of life you come from, if you want to call the shots, make your own decisions on the Forex, you get to do it 24 hours a day. And that is why people are slowly moving to the Forex. Now, there's 2 types of traders on the Forex. One is a consumer trader. Consumer trader is a trader who acquires ownership. If you purchase any sort of stock that you wanted to acquire ownership on, you believed in the leadership of that company, you believed in the product that they had to sell, you wanted to participate in its growth, you purchased that stock to acquire ownership. That is considered a consumer trader. If you have a savings account, let's just say you're Japanese and you have a yen savings account. Let's just say you're Australian, you have an Australian dollar savings account. Let's just say you're an American and you have a US dollar savings account, or a Canadian, you have a Canadian savings account, and you save money in that account. You are a consumer trader. You are saving money and trying to acquire ownership. Speculator traders are very different. They are not trying to acquire ownership. They are basically trying to anticipate price movement. They are trying to profit off of that price movement. They are virtually scalping profit as the market moves. Investors can be individuals, they can be banks, they can be businesses. Either way, speculator traders are anticipating price movement and scalping the market for profit. Now, there are 2 types of positions you will take in the market. One is what's called a day position, the new buzzword of the decade, day traders. Day traders in the stock market get in as soon as the stock market opens in the morning and gets out in the afternoon. That is considered a day trader. A day trader in the currency market, however, is a little different. Their day starts at approximately 3 p.m. for most brokers and goes until 3 p.m. the next day, which means if you enter into a trade at 6 o'clock in the evening and get out at midnight, you are considered a day trader. If you get in at 10 o'clock in the morning and get out at noon, you are considered a day trader. However, if you get in at 10 o'clock in the morning and get out at 5 o'clock at night, you are now what's called an overnight trader. An overnight trader is an individual that gets in today and out tomorrow. Perhaps 2 days later, 2 weeks later, 2 months, 2 years later. Warren Buffett purchased stock 40 years ago. He is a position or overnight trader. He is still in the market today, anticipating price fluctuation and every now and then selling off some of his shares to profit. Traders have been attracted to the currency market most recently, especially small speculator traders, because they are very trending. They have a tendency to trend down for what's called several 100 or 1,000 pips at a time, and then trend back up for several pips at a time. In the stock market, they call those points. We're going to discuss what a pip is here shortly, but in the currency market, you can acquire software that can participate in giving off buy and sell signals. You can see here, this is a buy signal. Based on this line crossing this red line, this is a buy signal. And one of these lessons focuses in on buy and sell signals and how to participate in that. You can see after this signal went off, the market rallied 1,000 pips, or if we were talking about points, it would be considered close to 100 points, and or perhaps 1,000 points. We're going to discuss that here. But be that as it may, speculator traders are turning to the Forex because it does offer a tremendous amount of trading ability. It allows you to make money as the market goes down, which is called short selling, and it allows you to make money when it goes back up. However, the reality of trading is this: 90% of all speculator or novice traders that try to trade in the market without some sort of help, mentorship, or education fail. Only 10% succeed. Why do you think the 10% succeed? Well, think about it. Successful traders will do what unsuccessful traders won't do. The 10% that succeed usually go out and educate themselves on how the market works before they get involved. And that knowledge gives them an edge. And with that edge, they're able to jump into the market and start profit taking from those traders that failed to educate themselves, and therefore the 90% pay the 10%. Now, trading on the Forex is called a zero-sum game. That means losers pay winners. The amount lost equals the amount gained. It's a lot like trading, or it's a lot like playing poker. See, when you play poker, the amount lost equals the amount gained. Losers pay winners on the Forex, which means if the odds are 90% lose and 10% win, for every 9 who lose, they pay the 10% that win. Therefore, if you can become part of that 10%, the returns are enormous. What's the objective of trading? Like all other companies, like all other businesses, to make a profit. And how do we make a profit? We buy low and sell high. It's no different in the trading arena. Now, how do we start trading currencies or stocks? Well, if you wanted to trade stocks, you would open up a stock account and acquire a relationship with a stock broker. On the Forex, if you want to trade on the Forex, you will find a Forex broker and you will establish a relationship for a margin account to trade with a Forex broker. If you do not know a Forex broker, we can help you find a Forex broker. You will need to open up a margin account. Now, a margin account, for those of you that don't know, is the following. If you open up a stock account of which you acquire no margin, that means if you put in $1,000 into that trading stock account, you now have access to $1,000. If you want leverage, that means you give the broker $1,000 and he extends you what's called leverage. He will give you 2-to-1, 3-to-1, 4-to-1 leverage. 2-to-1 leverage means that if you give the broker $1,000 with credit approval, he will then give you another $1,000. You now have access to $2,000 in buying power. Or 4-to-1 would mean you would have access to $4,000 in buying power. In the currency market, there's what's called 100 to 1 leverage. For every $1,000 you put in the market, you will be controlling 100,000 in currency, and there is no credit needed. We're going to discuss how this works. And you can day trade this, or you can overnight trade on the Forex. Now, what's traded on the Forex? We trade what's called currency lots. In the stock market, you trade stock certificates. We trade currency lots. One lot equals approximately $100,000 traded in another country's currency. Now, this is how it's going to work. The broker, when you open up a margin account, is going to give you the right to be a bull or a bear. Now, let me discuss the terms of a bull. If you think the market is going to go up and you want to participate in its move, and you enter the market buying first, you are considered a bull. That's where you enter the market buying first and then exit selling second. The market movement is up or rallying. Your position is long or bullish. You will need to come out selling at a higher price in order to make a profit. Bulls buy, try to buy low and sell high. Look at what this indicator is doing, giving off buy signals and sell signals. Look at here, buying at approximately 104, selling at 105. These are called pips. When you buy low, sell high, buy low, sell high, buy low, sell high. These three moves based on this indicator offered what's called 290 pips. Trading one currency lot, $1,000 investment, controls one lot. This is bringing a return of approximately $2,900. Times that by 3, you have a return of $8,700. Times it by 10, you have a return of $29,000. So currency is not only very liquid and highly leveraged, it can also be very profitable. If you believe the market is going to go down, the broker also gives you a right to short the market, which means if you believe the market is going to go down and you want to participate in profiting as it is falling, you will then want to enter the market as a bear. You will sell first and you will come out buying second. As you sell first, you will want to sell high and buy low. Therefore, you have bought low and sold high. Now, if you sell first, you are telling the world you are a bear. You will then want the market to fall or go down or what's called dip. As the market dips, it is also called reacting. The position you have taken is a short position or a bearish position, and the market you're wanting is a bearish market, which means you want the market to come down. You can make the same amount of money as the market is falling as you can as the market is rallying. That is one reason why a lot of people are moving towards the Forex. As the currencies are volatile, they are able to make money as it goes up and money as it comes down, and there are no specific rules to shorting the market. It is very different than the stock market. Bears like to sell high first and then buy low second. You can see once again here's a signal based on a piece of software that we have that offers a sell signal. You can see if you entered the market first selling and came out buying second, you ended up buying low and selling high. Here you sold at 107 and bought it at 104. Therefore, you bought low and sold high. If you buy a product for $104 and you sell it for $107, did you make a profit? Of course you did. These two moves on a $1,000 investment equated to $3,500 return. These two moves on a $10,000 investment would bring a $35,000 return. Learning to short the market is very simple. We teach people how to short the market in our courses. Bottom line is the trading process works like this. Whether you are a buyer or a seller, whether you're a bull or a bear, you'll deposit money into a margin account. You'll place orders via the computer. Your orders will go to the broker, and the broker at his choosing will offset it on the interbank market. He will manage his portfolio. That's what makes him a market maker broker. Now, how does currency trading work? It's a financial game between bulls and bears. Bulls want the market to go up and bears want the market to go down. But let's keep this simple. The Forex, like all other markets, can only go up, down, or sideways. And here at Market Traders Institute and ForexTips.com, we teach you and give you a strategy on what to do as the market goes up, what to do as it goes down, and what to do as it goes sideways. Now, how do traders get paid? Well, we get paid by collecting pips. Envision this chart. See, the market is going up, and then it is coming down, and then it goes back up, and then it comes back down, and then it goes back up. They say the markets don't go up and they don't go down. They're constantly going up and down. Trading is all about price movement against time. This is time. This is price movement. You can see, let's call this a stock. Let's call this GE stock, $103, $104, $105, $106. Let's just say you had an indicator that showed you to buy a stock at $104 and sell it at $106. You would make $2 a share. Now, let's just say instead of buying and selling one stock, you bought 1,000 shares at $104. And you watched the market rally and go up, and you sold all 1,000 shares at $106. You therefore made $2 a share, or $2,000. However, your investment to buy 1,000 shares at $104 a share ended up being $104,000. You had to place at risk $104,000 in order to make a $2,000 return. Now, let me explain to you the difference between trading stocks and trading currencies. In the stock market, this is called the stock price over here to the right. In the currency market, this is called the exchange rate. This is exchanging, and as a matter of fact, we're looking at the Japanese yen traded against the US dollar. This is the exchange rate of 104 yen traded against the US dollar, which means if I was to hop a plane, go to Japan, and go to one of their currency booths and hand them $1, they would give me 104 yen. However, I don't want you to think that 104 yen is a lot of money. It is not a lot of money. A soda in Japan runs about 200 yen, just like it runs approximately $1.50 here in America. Now, currency is constantly moving up and down and up. And you can make money as it goes up and you can make money as it goes down. But because we are trading $100,000 at a time, that means that as the currency moves from 104 yen to the dollar to 105 yen to the dollar, that means that this is a 1-point move. Just like in the stock market, this is a 1-point move. In the stock market, this would be a dollar increase. In the currency market, this is called a 1-point increase. In the stock market, in a dollar increase, there is 100 pennies per dollar. In the currency market, this 1-point move has what's called 100 pips. 100 pips equal a point. Now, each pip, depending on the currency you trade, comes in at a different value. 1 pip is approximately $10 in value because we're trading $100,000 in currency. I don't want to confuse you here. What I'd like you to stay focused in on is this, that as the market moves, it trades in pips. And currency traders are trying to acquire pips. And so a 40 pip move or a 50 pip move, which would be a half a point, is worth $500 at a half a pip. Now if I took $1,000 and bought a currency with it at the exchange rate of 104, and it rallied to 106, and I made 2 points, I really made 100, 200 pips. At $10 a pip, that is a $2,000 return. $10 times 200 equals 2,000. That is a $2,000 return on $1,000, and I didn't have to invest $104,000 to get the $2,000 return. Because of that leverage, traders are moving to the currency market because they are able to trade more for less. Now 1 pip equals approximately $10, give or take. Whenever you boot up your software, the software will always tell you, depending on the currency you're trading, how much you're making per pip. The price per pip, depending on the currency, runs approximately $6.50 all the way up to $10 a pip, depending on the currency you're trading. For demonstration purposes, we're going to go 1 pip equals $10 approximately. Currency traders make money accumulating pips. Now once again, for a quick review, if you had a $1,000 investment in the stock market, you purchased 10 shares at $100 a share, it moved 1 point, you would make $10 because you owned 10 shares at $100 a share. That is a 1% return. On the Forex, if you had $1,000 that you invested and you purchased one currency, you are now controlling $100,000. It moves 1 point. There are 100 pips in a point. At $10 a pip times 100 pips, you are making $1,000 or a 100% return on $1,000. Technical traders learn to read charts. To a technical trader, a chart is telling a story, and it's a lot like an x-ray to a doctor. See, to the trained eye, these charts are telling the trader where to get in and where to get out. Technical analysis gives the traders a high probability of knowing where the market is going. Why is that? That question is very simple to answer. Charts do nothing more than monitor the buying and selling habits of traders. And traders are human beings. And human beings are creatures of habit. We like to do things over and over again. Therefore, as we do things over and over again the same way, we become repetitive. We become habitual in our buying and selling. And charts do nothing more than monitor our habits, which means they repeat themselves. And learning that repetitive nature of a chart allows a trader a high probability of becoming successful. A chart is a chart is a chart. It doesn't matter whether you're reading a stock chart, a currency chart, a Forex chart, a mutual fund chart, the Dow, the NASDAQ. Technical analysis is applicable to all markets and anywhere you can pull up a chart. And once you've been educated on how to read a chart, you will start to control your financial future in your investing habits. Now, beginner traders focus in on what's called Japanese candlesticks. Japanese candlesticks are a little more user-friendly than bar charts. Whether you're reading a line chart, a bar chart, or a Japanese candlestick, basically what is taking place is they are monitoring price movement against time. If we were looking at a Japanese candlestick, it looks just like a candle. And you can see the body of the candle looks just like a candle. And on the north side and the south side, there are lines. Those lines are called wicks. Now, these wicks can be in any time period. You can have a 5-minute Japanese candlestick, a 10-minute Japanese candlestick. You can have a 1-hour Japanese candlestick. You can have a day, a month, a year, which means if this was an hour Japanese candlestick, that means that the prices would open up at, let's just say, 12 o'clock in 1 second and go literally for 60 minutes and close at 1 o'clock. At 1 o'clock and 1 second, a new candle would begin. During that hour of movement, prices would be moving up and down. And so, therefore, there's virtually two types of candles. There's what's called a bullish candle and a bearish candle. If it's a bullish candle, the prices would open up at a certain price, perhaps rally or go up, perhaps come back down and fall. As they came back down and fell and went lower than the opening and rallied again, it would then leave a line behind which is called a wick. That line monitors the low during that hour period. As they continued to rally, if they rallied and made a high and returned and came down to and closed at 1 o'clock lower than the high that it reached during that hour, this would then create a bullish candle where the close is higher than the open. The wicks monitor the high and the low. A bearish candle is absolutely opposite. The open is higher than the close. If the prices opened up, then they rallied, created a high, then fell. It would leave a wick behind as they continued to fall and established a low, but then closed higher than the low. It would then create a bearish candle, meaning the close is lower than the open and prices are falling. On a bullish candle, prices are rising. On a bearish candle, prices are falling. Look at this chart. You can see usually all your bullish candles are white and all your bearish candles are black. And depending on your software, you can change the color of your candles, but predominantly your bullish candles will be hollow and your bearish candles will be filled or black. You can see here now how the market rallied with bullish candles, came down with bearish, rallied with bullish, came down with bearish, rallied, market went sideways, then dipped. Look at all the bearish candles, then rallied again. Look at all the white candles. These candles monitor the open, the low, the high, and the close. These are called Japanese candlesticks. Once again, bullish or white, bearish or black. Now, Japanese candlesticks as well tell a story on all time frames. And some of the stories they're telling are called what's called engulfing candles, morning stars, evening stars, doji stars, and tweezer tops and bottoms. These are indicators that give traders an opportunity to get in. Look at this formation of these three candles is called an evening star. The opposite of that is called a morning star. This formation is a morning star. This is an engulfing candle. They come on all time frames. This is a 30-minute time frame. Look, this is a 2-hour Japanese yen time frame. This formation is an evening star, which means the market's getting ready to fall. Look at as that evening star appeared, the market fell. Look at this is a tweezer top. You can see it. Looks just like a tweezer. Look at this is a tweezer bottom. When tweezer tops and bottoms form, the market on a tweezer top should fall after a tweezer top appears. It should rally after a tweezer bottom appears. Let's look at these. Here is a morning star. When a morning star appears, the market should rally. It rallied after that morning star appeared. Look at this morning star. It rallied after that, turned into an evening star, dipped. Another morning star appeared. It rallied after that. We teach people how to identify these morning stars, rally, tweezer tops, reaction, tweezer bottoms, rally, tweezer tops, reaction. We teach people how to take advantage of these moves so that they can make money in the market. That's called technical analysis. We have one lesson dedicated to trading Japanese candlesticks. They have rules where to get in, how to identify them. It is a great lesson and well worth it to get involved in learning how to read Japanese candlesticks. Trading is nothing more than an auction. There's buyers and sellers. If you've ever been to an auction, you will always see a group of buyers trying to sell, a group of buyers trying to purchase something from the seller. In the market, there's lots of sellers trying to sell their products. When they are selling in the market, they are asking for a high price. And that's where the term ask comes from. If I was selling, let's just say a pen, I have a pen in my hand. If I'm selling this pen, I am asking $10 for this pen. You may offer to buy this pen for $5. Therefore, now I have buyers and sellers. You are buying at a low price and you are bidding. That's where the term bid comes from. Therefore, a buyer is bidding, a seller is asking. It's called the bid-ask. There's a term you're going to learn a lot about as you get involved in trading called slippage. And slippage is when you place an order in the market and you're not filled at that number and you're filled at a different price. That is called slippage. As you get involved with trading, we'll go into great detail about what slippage is. All charts that you look at predominantly are called what's called bid charts. They are monitoring the bid price. The current price that you see on the chart is the bid price. Remember, there's a bid ask? And as I was selling this pen for $10, you were offering $5 for the pen. That difference between $5 and $10 is called a spread. There was a $5 spread. If you are looking at a bid chart, then this is monitoring the bid price. The ask price would look identical to this. Now, once again, these are points. In this point, there are 100 pips. The difference between the bid-ask or the spread in currencies runs approximately 3 to 5 pips, which means an ask price would literally be 3 to 5 to 10 pips difference depending on the currency you're trading, which means the chart would look identical to this one. An ask price would look identical to this bid chart. It's just that it would be approximately 3 to 10 pips higher. Traders look at the bid price. Remember, we buy on the ask and we sell on the bid. A buyer buys from a seller and a seller sells to a bidder. You do not buy on the bid and you do not sell on the ask. You buy on the ask, you sell on the bid. Once again, if you enter the market and you are buying, you buy on the ask. If you place a protective loss stop order because you bought first and you are a bull, your protective stop loss sell order will be on the bid. Your profit limit order, which is a sell order, will also be on the bid because we sell on the bid. We sell on the bid. We buy on the ask. If you short the market and you enter the market selling, you then sell on the bid. Your protective stop loss orders will be on the ask, which means if you enter the market selling, your protective stop buy order will be on the ask, which means if the candles rally up to that level, that means the ask will hit that level before the bid will, which means if you have a stop order right at that price, the ask will hit it. The bid may not record it because they're of that 3 to 10 pips spread. Therefore, as you get involved in trading, please be cognizant that you buy on the ask, sell on the bid. Be very clear on that so as you don't get confused and feel that you have been wrongfully filled or that your order was not properly executed because the candle never got there. Now there's types of orders. Are a market order that is an order placed to get in the market, at the market. There is a bid and an ask. And if you want to buy, you will buy on the ask. If you want to sell, you will sell on the bid. Whenever you get in the market, at the market, you are subject to whatever the current trading prices are, the bid or the ask. And that is called the market. I am buying at the market, that means I need to know what the bid and the ask is. A limit order is an order placed to enter or exit the market at a specified price. And there will be no slippage on that, and you will get that price or better. A stop order is an order placed to enter or exit the market at an exact price, but as soon as the market hits that order, it turns into a market order and is subject to whatever the prices are at the market and can incur slippage. Not all stop orders incur slippage, but a large majority of them do. Rules to entering and exiting the market. If you buy above the market, it's called a stop order. That order you place when you buy above the market is called a stop order. When you sell above the market, that's called a limit order. When you buy below the market, that's called a limit order. And when you sell below the market, that's called a stop order. Now, if you want to ask me why, all I can say is those are the rules. The rules are when you buy above the market, it's a stop order. When you sell above the market, it's a limit order. Meaning this. Here's the market right here. If you think the market was going to rally and you place an order to buy at 109.50, that order is called an open order, it's called an unfilled order, it's called a working order. That order is placed above the market. Therefore, if it's a buy, it's called a stop order. If it's a sell, it's called a limit order. If you place an order below the market, you think that if the market was going to fall from here and go to 106.50 and you want to buy below the market, that order at 106.50, which would be a working order, an open order, is called a limit order. If you are buying below the market, if you are selling below the market, it's called a stop order. This is something that is very easy to understand. It can be confusing at first, but don't let that concern you. Usually as you get involved trading, you will understand that within after the second day of learning to trade. Now, ordering rules. If you want to enter the market as a bull, you should have two exits. If you enter as a bull, your position is long. You should have a sell order for profit and a sell order for protective loss stop. After you enter the market, predominantly your limit order is for profit, your protective stop loss order is for loss. Now let's look at this. Market breaks the trend line right here. You can learn a lot about trend lines in lesson 5. In lesson 6, it enters the buy zone. Lesson 6 will teach you all about how to get involved in trading in the markets and how to enter the market when the market enters the buy zone. Be that as it may, let's just say you buy right here, you buy on the ask, you'll have a stop order. We teach you where to place your stop orders to protect yourself, and look at as the market entered the buy zone, look at all this profit it made. Risk, here was the entry, small risk compared to big reward. We talk about that in equity management, lesson number 3. Ordering rules for selling. Every entry should have 2 exits. If you are selling or shorting the market, your position is short, you are a bear. Remember, you will need to buy low and sell high. You will buy low. That will be your limit order. Your protective stop loss order will also be a buy, and that is called a stop order. Once again, the opposite takes place. Instead of a buy zone, market breaks the trend line, enters into the sell zone. We teach you in lesson 6 where to get in. You enter the market, selling, you sell on the bid, you place a protective stop loss order. We teach that once again. Lesson 3 teaches you where to properly place your protective stop loss orders. And look at all this profit being made after the market entered into the sell zone. Your limit order for profit. Market continued to fall. Order execution procedures, OCO, one cancels the other. After you enter the market and you place your buy and then your 2 sells, when the market hits one of those sells, it will cancel the opposing order. That is called an OCO. After entry in the market, a limit for profit order and a protective stop loss order should be placed. When either the limit or the stop order is executed, it will cancel the other order. The other one is called a cancel replace. Any order you cancel and replace with a new order. Now let's look at this OCO. For whatever reason, this indicator gives off a buy signal. You enter the market buying here. You place a protective stop loss order just in case the market falls, you want out. If it rallies for profit, you want out here. Whether it hits the limit order first or the sell order or the stop loss order first, it will cancel the opposing order. Let's say the market rallied, hit the limit order, paid you out your profit, it will automatically cancel your opposing order. One cancels the other. A cancel replace means you enter buying. You do not have a limit order. You're going to do what's called chase the market for profit. However, you do place a protective stop loss order. You quantify your stop as the market continues to move. You cancel and replace that stop, locking in profit. Market continues to move, you lock in some more profit. Market continues to lose, you lock in some more profit. Look at all this. Cancel, replace, 500, 1,000, 2,000. Lesson 16 talks in detail all about different trading strategies and how to maximize your profits as you trade. Because of this reality that 90% fail and only 10% succeed, and because the 90% that fail pay the 10%, remember, successful traders will do what unsuccessful traders won't do. Successful traders will take the time to properly educate themselves before they get involved in the market. They will find out all the do's and don'ts in the market. They will find out how to make money in the market. They will find out how to financially protect themselves in the market. Successful traders always focus first on capital preservation. They want to hold on to the actual income they have earned, and they want that income to make more income for them. So successful traders educate themselves on how to have their current income make more income. There are 2 ways to pay for your education when it comes time to learning how to trade. The first way is luck. You can try to be like the rest of those 90% out there that are out there trying to get lucky. And if you make money from trading and you don't know what you're doing, you just got lucky. As the saying goes, if you have to be told where to get in, you'll have to be told where to get out. And if you become lucky, it'll only be a matter of time that you'll become unlucky and lose everything. You may want to get involved with what a lot of people are doing. They are stopping to give money to their broker because many times they end up broker. They're trying to educate themselves on how the market works. They're trying to take control of their portfolios, and they're trying to stop getting lucky. They're trying to become educated because you can learn how the market works. The second way is mentorship. Working with a mentor and getting an education on how the market works. Market Traders is a mentor. ForexTips.com. We are mentors. We teach people how to trade. Acquiring a mentor is a lot like buying a map to a gold mine. If I said, hey, there's gold in them there hills over there, you could walk over to those hills and you could kick over all kinds of rocks. How many years would you spend over there? Who knows? How much time could you spend over there? Who knows? Be that as it may, you could be there for years. A quicker way is to buy a map to the gold mine. Learning technical analysis to a large degree is like buying a map. It basically tells the trader where the gold is, how to financially protect themselves, and how to properly extract the gold out of the gold mine. You will learn where to get in and why, and you will learn where to get out and why. So when you start to trade, if you trade based on luck and you become unlucky, the problem with that is you will need to become lucky again to get your money back. If you properly educate yourself and you end up losing money, the neatest part about that is you've been educated on how to earn it back. You've been educated on how the market works. Banks can take your house away. They can take your cars away. The government can come in and take things away from you. One thing no one can take away from you is your education. Once you've been educated on how to do something, no one can take that away. Mentorship, educating yourself on how to trade, is very critical to your financial success. Let's face the facts. Every trader wants the market to move in their direction from entry. Education on how the market works improves those percentages. These 16 lessons that we teach on trading, focused in on the Forex, yes, but these 16 lessons on trading focus in on technical analysis, which in turn teach you how to trade. There are several trading exercises in these lessons. Doctors operate on cadavers first. As we teach people how to trade, we want them to practice first. One of the greatest things we ever did was create some software that allowed people to open up what's called a demo account. It's where we give you approximately $50,000 of monopoly money. As you go in and you practice these techniques, you are allowed to practice on that demo account. We highly recommend that you should only open up your real account after you have become proficient in your demo account. Once again, doctors operate on cadavers first before they operate on live people. We think that you should create a track record of success. You need to prove to yourself that you know what you're doing before you enter into the market with this demo account, way before you trade live. Traders, most successful traders, if not all successful traders, have a mantra. We feel our mantra should be, or your mantra should be, that you will educate yourself on how the market works. You will learn how to find and place a trade. You will trade with equity management and quantify that loss on every trade. You will never trade without a protective stop. You will not chase the market under no circumstance. You will be patient and wait for the right setup based on your education. And if the market does not meet the criteria of your trade, you will not trade. And if you can stay true to this mantra, it will participate greatly in bringing you the success that you're looking for. Now, in closing, did this lesson teach you what the Forex is? Did this lesson teach you how to trade on the Forex? Did this lesson teach you that the Forex is a market for speculator trading and that profits can be made, that the Forex moves just like any other market, up, down, and sideways, and that there's different types of orders used on the Forex, and that you should place a protective stop-loss order on every trade you make? Trading on the Forex can be very easy. By the click of a mouse, you can get in the market. By the click of a mouse, you can get out of the market. Please remember the 21-3% rule. If you don't use it, you'll lose it. And in closing, I would like to say thank you for taking the time to invest in yourself and for purchasing this lesson. We really do appreciate it. If you are going to invest in the market, your family will appreciate the fact that you are doing what successful traders do. They have a tendency to educate themselves and learn how things work before they get involved. I commend you on taking the time to educate yourself on how the market works. And on behalf of Market Traders Institute and ForexTips.com, I would like to say thank you for investing in yourself.